This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back to Macro Analytics.
Morning, Gord. Great to be back.
The month goes by pretty quickly, doesn't it?
Yeah, they all do. And it seems to be accelerating the older I get.
I have noticed the same thing. Anyway, our listeners don't want to hear about our aging process. So you've published a couple really good articles, as usual, but that I really want to focus in here on today. And I want to jump right in so we have enough time. But though you didn't call it this paradox of inflation, and just a background for our listeners, I have up here a chart that shows inflation. And you can see how dramatically higher or different it is for emerging markets being higher, and for the developed markets, how much lower it is. And you can see Europe dramatically falling off and probably going to force Draghi to do some things. The BRICS, what I call the Fragile Five, the kind of problems it's creating as the developed world effectively is exporting inflation. And to some degree, the emerging markets are exporting deflation to us. So, John, I have up the two articles that you wrote this month, Deflation Shock Coming, and then part two.
With these two articles, I was focusing on the developed world. And the developing world inflation story is a separate thing, but equally fascinating and scary. But what I was saying was that we are trying so hard to increase inflation in the U.S. and Europe and Japan. And it seems that we're failing to an extent lately, especially in Europe right now, where they've had a relatively tight monetary policy compared to the U.S. and Japan. And their inflation rates in most European countries are trending towards zero right now, with the danger that they're going to tip over into negative numbers. In other words, they'll have actual deflation where prices start going down instead of up. And in a healthy economy, that's to be expected, and it's basically a good thing because it means you're getting more productive, you're producing things for less, and you're generally doing better. But in an over-leveraged economy like Europe and the U.S. and Japan, deflation is basically death because it makes debt harder and harder to manage because you got to pay it back in more valuable currency over time. And the risk then becomes mass defaults as people can't pay back their debts and a tip over into some kind of 1930s style depression. And that's what Europe is staring at right now. And if they do allow the process to go on and they do tip over into actual deflation, that's going to spread to the rest of the developed world, and it's going to be a massive crisis. So the thinking is, and it's official now, Europe has basically announced they're going to do it, is that they're going to begin some kind of a quantitative easing program in the year ahead in which they start buying back the sovereign debt of the constituent countries of the Eurozone. And because of that, interest rates are plunging across the Eurozone. You're seeing Italian and Spanish and Greek bonds get more and more valuable, and their interest rates plunge because everybody's starting to assume that the European Central Bank is just going to buy this crappy debt back at whatever price when the time comes, and that you can actually make money by lending money to Spain for 3% for 10 years in the current marketplace, which is pretty crazy. I mean, that's comparable to what the U.S. has to pay to borrow. So you got now, Spain and Italy borrowing for the same rate as us. And that's not because anybody thinks Spain or Italy or the other peripheral Eurozone countries are actually good credits. It's that they expect the European Central Bank to create trillions of new euros and just buy this debt up.
Nor, John, does it reflect that we're such a great credit risk either.
Oh, no. I didn't mean to imply that we were a good credit. Yeah. Only that Spain and Italy are in even worse shape than us. And by any statistical measure, they're in depressions right now, and they're going deeper into depression instead of coming out of it. So they're not the kind of country that you would normally rationally lend money to, and yet everybody is. So what that means going forward is basically an issue of timing for the developed world. And that is, do we have the deflation shock first? In other words, does Europe and possibly the US and Japan, do we tip into some kind of a deflationary spiral that terrifies the markets and makes everybody pile into government bonds and out of risky securities like equities or to an extent leveraged real estate, and send us back into something like 2008 where the leveraged speculating community basically had a nervous breakdown? Or do the markets look ahead to the next wave of quantitative easing in which all the central banks of the developed world have to react to deflation by flooding the system with even more currency? And do we get a huge new spike in risk assets? In which case, the equity markets, as overvalued as they are in most of the developed world, will go up even further from here, and more trophy real estate will be bought by people with incredible amounts of money to burn. And we'll see more of the same, and an even bigger, more destabilizing asset bubble form. So neither of those scenarios are good.
John, as you know, I've done a fair bit of work on this, and what you just laid out is exactly what my work has concluded, and that is you're going to have both, and it's the sequence we're going to have, and we're going to see, and we're experiencing a real deflation scare, and as we drop, but it is my opinion before it gets too deep, because it's through all the developed countries, because it's a collateral problem, and the non-performing loans nailing the collateral or impacting the collateral. It's my opinion that the governments will step in and start guaranteeing collateral before we drop very far, because we're so highly margined with rehypothecation right now. Any kind of collateral deflation of even, say, 15%, which is pretty minor, would put us into full collapse. And when we start to therefore react to that, which we will be forced to, and print the money, we will do exactly what you said in the second stage. We will see inflation move to hyperinflation, and a huge move up. It's my opinion. And I'm personally been saying that for quite some time. And to me, it's almost tracking right to an R squared fit.
Yeah. And which kind of implies early on hard times for the stock market. You've got a lot of really juicy short sale candidates out there in this kind of a scenario, because there's a lot of overvalued equities, and there's a huge amount of real estate that probably isn't worth what the last person paid for it in a deflation scare scenario. So yeah, that's a recipe for turmoil in the year ahead.
Exactly. We think there's a stock market scare, correction, consolidation coming, but it isn't the one that's going to be really major. It will be enough that there's going to be, and I believe it's an orchestrated bond rotation to fund the developed countries, which will drive down bond prices up and dive down interest rates. And pushing the bond prices up will help pension plans and insurance companies and the banks, obviously, who are the bond buyers, but it'll force, through really effectively financial repression, more buying of bonds, which will help the governments at lower interest rates. And they need this rotation with the piling on of the debts, but it's not a sustained one. And we will flip back and have an asset appreciation in equities in a blow-off. And it's really a Minsky melt-up that we have not experienced yet. We've seen parts of it. And if you look at the stock market, I mean, it's hyperbolic right now. It's beyond bizarre. And so any kind of correction, but they can't allow it, because all this money printing, we went way too far on it, John.
Yeah. And the problem with the whole, currency war scenario is that it doesn't work for everybody at the same time. For instance, if Europe decides they're going to embark on some kind of massive quantitative easing debt monetization program where they flood the world with euros, that theoretically that would make the euro go down, but versus the dollar. So they're basically exporting their deflation to us in that kind of a scenario, because our currency gets stronger, which hurts our exporting industries, which slows down our economy and is bad for our stock market. So, so many bad things can happen, and it's really hard to tell which one happens first. But I kind of agree with what you're saying, that we get the deflation scare first.
That's the key.
Yeah.
I don't think it'll be allowed to get out of control like it should if we're going to get a true correcting readjustment. The governments will be forced to step in with various programs very, very quickly. Yeah.
So is it, after a 5%, let's say, decline in the S&P 500 in the U.S., is that when the Fed steps in and says, don't worry, we got your back? Or are they going to wait for 20%,
The number we have in our mind is 12%, but who knows? But I would suspect it's somewhere between 10 and 20%. That you could see before they will be forced, no choice, to come in with new programs. We're a long ways from these central banks having completed what they're going to be forced to do. We haven't got to the stage where they're going to panic, and they will panic. And their reactions will really fire up a Minsky moment. And
they so far have been able to succeed at least in staving off the collapse that you would normally expect from a world that's this awash in bad paper. So the question really is, at what point do they run out of ammunition? When will it be that a new round of debt monetization doesn't have the desired effect on the financial markets?
John, I think the answer is happening in real time. What happens is food prices themselves, true inflation, start to go up. And we're seeing that in these emerging markets where food is a higher percentage of people's disposable income, which creates huge social issues. And then you're also seeing in countries that are borrowing, not just the developed world, but now we're seeing it in China and Asia with their debt, that the marginal utility of debt is nowhere near what it should be and is falling. So they're now having problems maintaining their growth. It's beginning to feed on itself. The money printing quantitative easing is not working, but by sustaining it, they can buy a little bit more time. It's my opinion. I think they can probably buy another year or two.
Yeah. And so in so doing, they push up asset prices. Because that's really the definition of buying time, is keeping the asset markets from imploding.
Intentionally, John. And in my opinion, they have to do that because I believe the next crisis is not a banking crisis. I believe the next crisis is going to be a pension insurance crisis because they're living off yield. And we've got, in America's case, 75 million baby boomers retiring for pensions. And all these pensions are seriously underfunded. So can you imagine if the asset prices start to fall off?
Yeah, well, that can't be allowed to happen.
Can't.
And
won't.
One other aspect of this is that buying bonds might not be the final tool left in their toolkit. And the next stage for the governments of the world might be buying equities directly, because if that's the part of the market that's starting to implode, and pension funds, along with a lot of individuals, have loaded up on risky assets like equities and junk bonds in the last few years, then maybe the government directly starts supporting those markets by coming in and buying the S&P 500 or whatever. And that's a really interesting next stage to this process, because we've never seen that happen on a global scale with trillions of dollars before. At least we've never seen it publicly happen.
John, I would speculate that that's happening. You're seeing in Japan right now the pressures on the largest pension plan in the world, 1.4 trillion, in terms of it buying the Nikkei and replacing the board of directors, so to force this policy. And I bet you anything, if we could skin the cat in the developed world, we'd find the insurance regulatories are changing behind the scenes to allow them or force them to be buying more equities. And they're being forced to do it to get the yield, but also being allowed to do it. And we never find these things out until after the fact, right? And to force exactly what you said happen, which forces up equity prices.
And you would think that in a rational world that would be seen as a sign of weakness, and it would actually spook the financial markets, because only an incredibly desperate government that's seeing these horrendous numbers, maybe not reporting them, but seeing them in their closed-door meetings, would do something like that. And you would think that would be a sign to just sell the heck out of every major financial market in the world. But that hasn't been the case so far.
The president of Citigroup said in 2008, you got to get up and dance while the music's playing. And he was scared with what he was seeing. And obviously it almost cost Citigroup this total solvency. And I believe, and I would speculate, that a vast majority of the CEOs playing this intermediation game understand exactly what we're saying, have no choice, because if they miss a couple quarters and falling off in earnings as this thing's rising up, they're gone. So it's called, hey, look, I just got to dance while the music's playing and hope that I'm going to be the first one to the exit. And we all know that never the case. That's
true for money managers, I guess, of course, as well, because they're judged by their most recent quarter in a lot of cases. And so
precisely.
They can't buck a trend that is in place. And if it looks like the government can force up equity prices for a year or two, then if you're a money manager, you basically have to ride that. You can't bet against it, because if you're wrong for even a couple of quarters, you have to find new work. And there's no guarantee that you find anything that's as nice as running some pension fund. That's a really cushy job. At least it has been historically.
Well, even personal investors today, you look at these charts and they're obscene, but nobody's selling and leaving because it's called, I just can't afford not to make more money. We're afraid we're more worried about not making money as opposed to losing the assets.
Yeah.
To some degree, I think the investors are a lot more conservative than they were before, but the money has been leaving the market has been institutions at a significant rate as the retail traffic has come back in here recently, which is very troubling.
Gord, if we have time, maybe we could jump over to the developing world for a sec, because that's an interesting part of the story that we haven't really had a chance to talk about yet. But as you were saying before we went live, when the cost of food and energy exceeds 40% of the average income in a given country, that's when you get civil unrest. And with the inflation that the developed world is exporting to the developing world, we're there in a lot of places. So the year ahead, if that relationship holds, we should see a lot more unrest in a lot of different countries. And that's destabilizing. That kind of feeds back to the developed world. Because if you got, Thailand or Egypt or whoever devolving into chaos, that creates problems for us that are in addition to all the other problems that we have. So, unrest, especially if it happens in, say, an oil exporting country. So this kind of thing is something to be watching, because it does feed back into our own situation here in the developed world. And it's yet another thing that could very easily happen in the year ahead, because this relationship has held pretty well in the past. And so we could see a lot of this stuff in 2014.
Our thesis paper and work that we do, John, has said for 3 years that that's what needs to be watching, is the steadily increase in social unrest around the world for various reasons, but food is always central. When you look at any of the major crises we've had, it's been preceded with major jumps in food prices. You look at the Ukraine, it started as food issues. Egypt started as food issues. And it's something, again, we were talking about before we began. What a lot of people don't appreciate is these governments that are in place subsidize food because food is such a high percentage of the population's disposable income, so the government funds it. When the governments get into trouble economically, they don't have the funding for it. And suddenly it's quickly out of control on them. And the United States has been a major foreign aid, supplier of foreign aid for years. And so when we change foreign aid to these countries, we literally remove people from power indirectly through the social unrest. And we've been doing that. And we orchestrate that as part of a very controlled foreign policy, for good or bad. I can't comment on that, but it's just a fact of the amount of money that flows through that way. And in our case, if we don't like the politics that's going on, we're obviously going to pull it. And so a huge amount of the Middle East, Central Europe, the unrest is food centric, and it was getting worse at a significant rate, John, when these food prices have really spiked recently.
Now, Gord, a cynic might look at the process of us exporting food inflation to these countries, which busts the budget of these governments, forces them to borrow more money from the International Monetary Fund, which is basically a branch of the U.S. government, and then become more dependent on us as kind of a backdoor form of imperialism, a takeover of these countries using economic instead of military means.
John, I don't know if you're talking as a cynic. You sound like you're talking as a banker. This is how the bankers look at it. This is good business.
Yeah, it's a very coherent strategy when you look at it that way.
And when you have unrest,
yeah.
you end up, countries buy a lot more military equipment.
Yes.
And, the banks make a huge amount of money from any country that's increasing large ticket items like military equipment. Whether they're going to fight a conflict or just policing or national security within the country. And by the way, John, we, and again, now I will be cynical, we, the United States, are probably the world's biggest exporter of military equipment.
Mm-hmm. And food. So we sell them the food, which costs too much. And then we sell them the military equipment to put down the unrest that comes from the food costing too much. Yeah, it's a really great deal when you think about it. We're so smart. We're just
John, we got a break. We're out of time, but there's so many subjects we kind of touched on here this morning. Kind of concluding remarks or way of tying this together?
Yeah, the year ahead has all kinds of landmines out there, Gordon. We've got inflation in some places and deflation in others, and overvalued assets, and so a lot could go wrong. And I think the question really that we have to be paying attention to is, in what sequence do they go wrong?
Precisely.
So that's really the key story going forward, and it's something that you and I will be able to talk about as it happens month by month going forward later.
John, can you tell our listeners how they could read more or find more of your writings and more of the work that you do?
Sure. I run dollarcollapse.com, and my newest book is co-written with Gold Money's James Turk. It's called The Money Bubble, and you can get it at Amazon or through dollarcollapse.com.
John, always a pleasure, and I've got to figure out how to keep our subjects a little narrower because there's always so much to talk about. And I think sometimes I feel like we leave our listeners with more questions than we do answers.
Well, since that's the way we operate with more questions than answers, I guess it fits, right?
So I asked our listeners to be patient with us. I always enjoy these. Talk to you again next month.
Yeah, great. Look forward to it.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.